Let's talk about that superlative.
Nice set.
Worst day since October 2008. I know that they missed, but was it really that bad?
Well, I think the expectations going into the second quarter weren't great because everyone knew that there are a lot of headwinds facing the company, especially as it relates to its new labor agreement with the Teamsters, which anniversaries on August 1st. That being said, I think demand was not as good, and also UPS was apparently hit by a mix shift of lower yielding, lower profitable freight. They've definitely seen a trade down where someone that might have shipped something via air decided to go ground, and someone that was using ground, maybe they're using their SurePost, which is more of an economy type product. And all these products have lower yields, which definitely impacted the top line. I think sentiment is really low on UPS, which is the old saying, it's darkest before the dawn. I think looking into the second half of the year, there are a lot of things that could go UPS's way if demand comes along, and that's a big if. And as you were talking earlier, it's all about consumer demand and economic activity.
Lee, because there's such a big if baked in there, what do UPS's earnings say about everything else, given that there's such a bellwether here?
The good news is that their domestic operations, which is really in the U.S., has seen volume growth inflect positively for the first time in about 10 quarters. That obviously to us is maybe telling us maybe the worst is over for them on the demand side. And then their international side, they noted that a number of their markets were starting to see growth again, especially as it relates to Asia. And again, these are incremental net positives. The company, also increased its confidence by reinstating their share purchase program. They're going to buy back around $500 million in the second half of the year, and maybe $1 billion next year. That's obviously a step in the right direction. Some of that is driven by, their plans to divest their brokerage business, which is called Coyote. RXO is going to buy that business. It's supposed to close at the end of the year, and that is expected to free up some cash, which is they're probably using towards those buybacks. But the big kind of takeaway here is that margins are just not going to be as good as they originally thought, and some of that has to do with A, higher labor costs, and B, maybe the product mix is not where they thought it was going to be 3 or 6 months ago.